Hello friends, in my previous video I talked about why to invest. Why should someone invest at all? Why should someone not sit on cash? What are the benefits of investment? Okay, in this video we will be covering about where to invest and what kind of investment provides what kind of return. What kind of returns you can expect from any kind of investment. Okay, we will be covering each investment in detail one by one. So let's go through them. So where all you can invest? You can invest in fixed deposits, you can invest in equities, you can invest in real estate as well as commodities. Commodities are precious metals like gold, silver, okay, all these things. So let's talk about fixed deposits. So fixed income instruments, these are the instruments with a very limited risk to the principal. Okay, these are the interest can be paid quarterly, annually, okay, at the end of the term of the deposit, okay, for whatever amount of term you have put that you put the savings, the capital is returned to the investors. Now fixed deposits are like the bank FDs, recurring deposits, etc. Government schemes like PPF, NSC. PPF provides a great return, like it's very famous. It provides a return of more than 8%. Like in the previous year it was providing 8.8%, in this year it is 8.1%. Okay, the bonds issued by the government of India, bonds issued by government related agencies such as HUDCO, etc. and bonds issued by corporates as well. So this kind of investment provides a return of typically 7 to 10% per annum. Okay, per annum you can expect a return of around 7 to 10% from the bonds issued by the government and these agencies. So they provide a typical return of around 7 to 10% per annum. Now let's talk about equities. So investment in equities involves buying and selling of public listed companies, shares of public listed companies. Okay, so the shares are traded on both the Bombay Stock Exchange and the National Stock Exchange. I will be talking about them in my next video. Okay, and you can also invest in mutual fund in equities via mutual funds. Okay, when an investor invests in equity, then unlike a fixed income instruments, there is no capital guaranteed. Okay, there is no capital guaranteed. This is very important to keep in mind. However, as a trade-off, the returns can be expected around 15 to 20% over a long run. So if you take the Nifty, or if you have a good portfolio or if an average portfolio as well, you can expect a return of around 15 to 20% over a long run. Like if you are looking for a long term, for short term there might be some losses. For short term, like for a 1 year, 2 year, if you are thinking, then you might get a return of around 30-40%, but you might lose also. But if you normalize over a long term, like say 5-7 years or 5-10 years, then definitely you can expect a return of around 15 to 20%. Okay, now let's talk about the next kind of investment, the real estate. Okay, it involves transaction like buying commercial as well as non-commercial land. You can expect a return of with the rental income, like you can rent your apartment, your office, etc. You can expect a rental income as well as the capital appreciation of the amount. 5 years ago you bought a property for 1 crores. Today its value is 1.5 crores. So that kind of return is possible. Now commodities, the bullion thing, these were the most famous investment in the previous age, okay, previous decade or so, in gold, silver. If you ask your father, mother, grandfather, they will say that invest in gold, silver. Okay, you can also invest in gold and silver or all the precious metals like aluminium, copper, okay, through exchange traded funds. You can they will be present with you in the electronic form. So as the prices of gold, silver varies in the market, accordingly they will change in the exchange traded funds as well. So they provide a return of around 8%. If you take the history of 20 years into account, you can see that they provide a return of around 8% per annum. Okay, so let's talk about let's summarize what kind of investment gives what kind of return. So by investing in in the previous video I took an example where you have started earning 6 lakh per annum, okay, and you are saving 2,40,000 and you are investing 3,60,000. You get an annual hike of 10% per annum and you are increasing your savings also by 10% per annum. So you have started your saving with 2,40,000. In the next year 10% more you will save, in the next year 10% more you will save. So after 20 years, here the data is shown, after 20 years what that savings will amount to. So that saving, if you are investing in fixed income, that will amount to 9% per annum, that the corpus would have grown to around 3.3 crores. If you take a return of around 9% per annum, the corpus would grow to 3.3 crores. Similarly, if you are investing in commodities that at a rate of 8% per annum, that corpus would grow to 3.09 crores. Okay. But if you are investing in equities at an average of around 15% per annum, the corpus would grow to 5.4 crores in 20 years. Okay. So this is really a great kind of investment. With the average or a good portfolio, definitely you can achieve this. Now you should invest as per the risk appetite. Okay, so like young person who has just started their career, they can invest 70% in equity, 20% in metals and 10% in fixed deposits. Because he has just started his career, he can take more risk and he has to save for a long term. Okay, so he has to save for a long term, so they can take that risk of investing in equities, because as I have already told you, if you are investing for 5-7 years, you can expect a good return. But for people who have retired, they should invest 80% in fixed deposits and 20% in equities, because in short term, if they expect something, that they might not get that kind of return from the equities. Okay. Now few points to keep in mind. Okay, like risk and return go hand in hand. Definitely you should understand, higher the risk, higher the return, lower the risk and lower the return. Okay, and investment in fixed income is a good option if you want to protect your principal amount. Okay, but it is relatively less risky. However, if you have the risk, you have the risk of losing money when you adjust the return for inflation. Okay, so you are investing in a fixed income instrument which is providing a return of 9% and inflation is 10%, then even though you are investing, you are losing 1% per annum. Okay. Real estate investment requires a large outlay of cash, okay, and cannot be done with smaller amounts. You definitely need a large lump sum amount with you, and liquidity is also another issue with the real estate investment. You cannot buy or sell whenever you want, whenever you wish. Okay, you have to wait for the right time and the right buyer or seller to transact with. And every day you will not find them. You have to keep patience and keep looking. Gold and silver are known to be relatively safer, but historically, if you see, then that it's not very encouraging. They provide a return of 8%, as we have already seen. Now, investment in equities is a great option. Okay, like it is known to beat the inflation over a longer period of times. Historically, also you can see that investment has generated return close to 14-15%. But I will again repeat that it is risky. If you have the risk appetite and you are looking for a long term, say for 5-10 years, then go for real estate investment. Okay, so friends, if you like the video, please like, share and subscribe with your friends. I'll be posting many more videos like this. Thank you.